Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. Welcome to the Improving Alpha podcast, where we explore innovation in investing, ESG, and technology. Today, renowned fellow Columbia Business School professor Mike Ewens joins us. We'll dive into his background before tackling the core trends shaping the industry. Investors, academics, and business leaders alike will gain immense value from his unique insights. On that note, welcome to the show, Michael.
Great. Thanks for having me. I'm looking forward to the conversation.
Great. To kick things off, Mike, why don't you tell us a bit about your background? Just briefly share how you got to where you are today at CBS.
So I guess it all started when I was a paper boy, but no, we won't start there. My academic history starts in graduate school. When I was in a finance course, I was offered an internship at a venture capital firm. And I actually had no idea what venture capital was at the time. I think I was a trade economist, or thought I was at that time. But I wanted to live at the beach, and this was a way to be able to afford a beach apartment. So I said yes. And in the course of that internship, I learned, of course, a lot about venture capital and got really excited about the alternative asset space. A lot of stuff is broken there, and how market participants fix or try to fix the problems that we typically don't see in public markets was fascinating to me as an economist. So that got me down the path of researching and teaching venture capital and private equity. I started my career as an academic at Carnegie Mellon, the business school there, and subsequently moved to Caltech in Southern California, where I was in their economics department. And then in 2022, I moved to Columbia to both be the professor I've always been in finance and alternative assets, but also to direct our private equity program, which is a collection of curriculum, research, and industry outreach that I work on day to day.
Great. And I've had the pleasure of joining you at some of your classes, which were fabulous. And anyway, let's start with the innovation in investing, the first component of this, and then we'll get to ESG and technology. So the private market explosion, let's talk about that first. In your paper, Private or Public Equity, it's become very prevalent, as evidenced by SpaceX, Anthropic, OpenAI. Companies are waiting much longer to go public in many instances, and accruing a significant amount of the value creation to the venture capitalists and the early investors and the founding shareholders. What's your conclusion? Obviously that leaves less return. I would think it leaves less return for retail by definition, or subsequent investors, later stage investors, public markets investors. But we're curious to hear your thoughts and conclusions.
So this issue, I think summarizing it is, private companies are staying private longer. So they're getting either acquired by large companies at a later stage of their life cycle, or they're deciding to go public later, is a phenomenon that's, I believe, started in around the late 90s. While the dot-com boom, which hopefully some of your listeners still know, my students, is they all stay the same age and you get older and they don't know all these real world events that happened. The dot-com boom was really the start of what I would argue is the private capital market boom. A bunch of regulatory changes occurred in the 1990s that made it easier for private equity, venture capital, and other alternative managers to raise larger and larger rounds of funds. And it made it easier for private companies to raise from a bigger pool of investors and locations. And this set off, I think, the beginning of what we're seeing today, which is just a huge pool of private capital across equity and debt markets. And my view is the examples you mentioned, Anthropic, OpenAI, SpaceX, these firms and these founders in particular, I think if you sat down with them a year or two ago and said, do you want to go public? They were honest about this. They say, no, I do not want to go public. I like running this firm. I like being in control. If you view the world through that lens, the average private firm CEO wants to stay private, and then you give them cheaper private capital, they will most of the time say, you know what, I'm going to keep raising this and stay private. I think this explains a lot of what's going on in the capital markets these days. And in more recent, the OpenAIs, the Anthropics, and SpaceX, I read their public choice. It's complex, but part of it is they've simply tapped out private markets. So the private markets are saying, you want 100 billion, the price is going to be a lot higher than it would be if you're public. And moreover, what public gives you that private still doesn't at scale is liquidity. So I think public markets, to round this out, still provide a very unique role of liquidity that private markets almost by design cannot.
Yeah, and I would argue further to your points, now they can have they have the best of both worlds, right? Because again, to your point, you and I have probably more history than students of today, right? But dual share classes, Henry Ford had a dual share class, and then for some decades, and based on my understanding, dual share classes were considered suboptimal from a shareholder governance perspective, which is, I think, generally largely the case, or I probably am not inclined to disagree with. And then with a lot of the tech companies, including some of the FANG or Mag 7 and others, dual share classes came back, and here we have it again with SpaceX and some of the others. So that's a long-winded way of my saying, it seems to me they can have the best of both worlds, because to your point, they wanted to retain control. Now they can retain control whilst not having necessarily a majority of the shares. But I'm curious to hear your thoughts on that diatribe.
Agreed. In fact, it highlights an important point of what price is in both public and private capital markets, right? When you're paying as an investor, most people think of it as, I give you $10 million, I get 10% of the cash flow rights. But of course, there's a much bigger contract involved in that transaction. And one of those could be the rights and privileges of the other side, in this case, the founder. And it's true that basically the growth in private capital has translated into the price of lots of things changing. And so founder bargaining power has gone up as capital has gone up. The cost of capital has gone down. And this is translated into dual class shares. What's interesting about that is that in most privately held firms, if you look inside pre-IPO, they typically don't have dual class until they go public. And so their means of control in a world where they have minority stakes will be board seats, for example. SpaceX, I think Elon, don't quote me, might be 13% of the actual common shares. But when he's basically running SpaceX, both as CEO, and the board is likely elected by his shares. So what this is a sort of overall view is that founders have more control both in private markets and public.
Totally. And that's a good segue just to wrap this part of the discussion up into another paper you co-authored on the regulatory cost of going public. And I believe you highlight bunching estimation, where firms avoid crossing regulatory public float thresholds. So my question there is, from an alpha perspective, what impact that has on public exchanges, and how should asset allocators think about that?
Honestly, this is the biggest question facing the broader public versus private debate, which is, what are we missing, if anything, as investors in public assets? What are we missing when the private asset pool is larger and contains, let's say, micro cap, mid cap, high growth firms that used to, at least some of them, go public? I don't think we have a good answer for what exactly we're missing from that as public investors, but this particular study does highlight that there's likely some real frictions in the kinds of firms that go public. So what we do is there's some nuanced rules, which actually in this specific case are likely going to change. There was a rule last week the SEC put out to change these rules quite dramatically. I'm happy to share it with you for your listeners. But what this rule does is it said, I'll simplify. If your float, which just for the sake of argument, let's call that valuation. If your valuation is below 75 million, then you as a firm have the right but not obligation to wait one extra month to file your 10Q And you don't have to follow rule number 3 of Sarbanes-Oxley. If you go above 75 million, you do. You have to follow all the rules. So what we find is if those rules are costly, that is, there's a benefit to avoiding them, you would expect a bunch of firms to say, you know what? I'm going to do my best to stay at 74.9999 million, right? So I don't trigger the rule. This is what we find. We basically find that firms bunch below these regulatory thresholds. Now, what does this mean for your question? To me, this means that if I'm a private firm facing a decision of going private to public, it's similar, right? I'm entering a new regime of rules. Public firms are trying to avoid these rules, presumably because the costs outweigh the benefits. It must be the case that private firms face the same issue.
So, like, where does that? So then, what's the corollary? Where does that leave? What should be done? What should change? Obviously, it's creating a distortion. To your point.
So this means, given it's a size, it's mainly a size issue, right? So in the public markets, the below, for example, 75 million, these firms are basically taking efforts and harming their firm a little bit just to avoid these costs.
Yep.
Take that logic now to small private firms that might have this decision to go public. That same logic's going to hold. There are likely small private firms that would benefit and would shareholders from them going public, and those small firms would presumably fill out certain features of historically public markets covering small, middle, and large cap firms.
Yeah. So basically, to your point, it's depriving public investors of potential exposure to companies that they might otherwise have had.
Yes. And this is where I started with maybe skepticism or uncertainty is I don't think anyone in my world, academics, have really documented this yet. That is, we have a big pool of now high growth, small, mid-cap private firms that historically used to be public.
Yeah.
What are we missing at a sort of, let's think of it at a portfolio level. What exactly are the risk factors, the correlates, the deeper correlates that those assets are providing that we no longer have? I actually don't think we have a good answer for that yet. I think we have an intuitive sense, but I'm trying my best as a researcher to solve this, and it's tough.
Okay, look forward to having you on a subsequent episode and seeing where you come out. All right, let's shift to segment 2, ESG, and let's start with biases in early stage pitching. In your paper, are early stage investors biased against women? You have some fascinating interaction data from AngelList that indicate male investors are significantly less interested in female founders, even when controlling for observable quality. I'm going to leave that open-ended for you to share more on that.
Sure. Yeah, these are important papers to write, but admittedly not the most fun because the results are a bit depressing. I think why this is important, there's two reasons. One is I think it's sensible to say that supplying high growth capital to startups is an important thing for the economy overall. It's, I think, one reason the US economy is so great is our entrepreneurial ecosystem.
Yeah.
Then the second is if you had to pick a set of investors in the world, I'm a little biased here, but if you had to pick a set of investors in the world that are profit maximizing, have skin in the game and strong incentives to just be pure financial investors, I think angel, or at the very least venture capitalists are there, right? They make 20 bets, one of them pays off. I think it's a bad place to be biased, right? You already have enough against you. That's one reason this is important. So what we found is what we did is you can see in this data all the startup founders that raised their hands and said, hey, I would like to raise some money. Here's my startup. Here's me. And we could see on the platform which investors reached out for interest. You could basically see introduction requests. What's important here is that I can actually see the folks who didn't raise capital, as opposed to only seeing among people who raised capital, what is the difference? That's a critical piece from a research perspective, is I want to know what actually happened both successfully and from a failure perspective. So what we find is just what you said. Men show what we argue is bias against women. What's fascinating about this is it's likely a combination of what you might call rational reasons, is that men infer somewhat correctly that women founders might be in industries they don't understand as well because there's sorting by gender in industry. There's concerns, so I don't believe, but there are concerns about risk taking. There's a cultural thing which is actually not shown up in experiments as much as people think, that women don't take the same risk as men. And as an investor, you might not want that. So that rule explains some of it, but the rest of it is just men seem to be on average, biased against women. And the way you can see this is women outperform men as founders in the data. So these men are leaving money on the table by showing a preference towards their own gender.
It's basically what you're saying is it's like the canonical in orchestras where some time ago when the men were discriminating against women in orchestras, and then when they could no longer tell that they were women because they were playing blind, the women improved their percentage ratio. You know what I'm referring to, right?
Oh, I know exactly. Yeah, the blind. This would have been a nice example of if I could have removed the names and all you saw was some signal of who the founder was without gender.
Exactly.
That would have been great. What we had was very good, not perfect. So a future researcher, someone did this, I recall they did this in a pitch competition where they showed some the faces and some didn't, and there was similar results that showing the face, much like the orchestra, changed the decision making. So we have a lot to do. We as a sort of, if I put myself in the industry, I do have a little foot in the real world. We have work to do, but it has gotten better. I think there's much improvement on this front. I think we can only get better from here.
Okay, let's next shift into private capital and economic inequality. You've examined the relationship between private capital market expansion and the rise in U.S. economic inequality, and I believe noting a material surge in finance coming from high net worth individuals, which is a trend I've observed, and previously at First Republic as well as more recently. And obviously, there's this whole notion of the democratization of alternatives, which to me is simply what institutions are full up and mature on alts, and the growth now will come from high net worth family offices, multifamilies, et cetera. But the question for you is, after that prelude, does it risk driving further economic disparity?
It certainly does. I think it certainly can. There's great work out of University of Chicago and Princeton about understanding wealth inequality in particular in the US, and a combination of asset managers like this, folks who have business ownership as their source of income and in turn wealth, explain a lot of sort of the upper wealth tiers in the US, and venture capital is a mechanism to get access to that. I think increasing access could help some of this to some extent, right? If at the bare minimum, like individuals who are not accredited, that's the extreme version of this, can find a way into venture capital funds, this could offset some of these gains, assuming fees and carry don't eat into everything. But overall, the venture capital space is a place where the right tail of wealth generation in the US comes from. And so any restriction there, I think, will only exacerbate this. It is a very tough question to answer because the US data releases do not look like the Nordic countries where everyone tells the government everything. So we can't tell you a perfect picture, but I think the access point here will have a meaningful impact on inequality overall.
Just to put, if I may, just to play devil's advocate, I know you're intimately familiar with these charts as well, but if you look at the dispersion of let's say, long-only equity returns, it's minimal among GPs. Whereas at the other end of the extreme right, the most dispersion of returns is, of course, in venture, right? And the negative quartile is solidly negative, if I'm not mistaken. And again, neither of us have it in front of us. But my question for you is, how though would retail not end up being in the middle half or worse, the bottom quartile, and then suffering from very negative returns? In fact, probably significantly worse than just beta to public equity markets.
Yeah, here's where more opinion, but I agree with you. So the facts, I agree on the facts. Manager dispersion in alts in general is bigger than what in publics. And venture is, I think, the highest dispersion. So when you're investing in this asset class, I like to say you're not picking investments, you're picking managers. And there are indeed some reason these bad managers keep raising capital. So I think the democratization push, my point was more theoretical earlier. If I had to pick an asset class where democratization should move last, it would be venture. There's two reasons. One, you just mentioned, right? It's manager selection. And even the best LP in the world, this is like a full-time job to find the best manager. So I don't know if a retail investor is going to be able to do that. But two is scale, right? If retail and high net worth get into this, it's trillions. The venture industry cannot take trillions of dollars, right? There are diseconomies of scale. So I would pick this as the bottom of the rung of where I would push policy to democratize for that reason.
Yeah, totally. Okay, fair enough. We're on the same page. Agree. Okay, and then let's shift to the last part of this segment, the social impact of PE ownership. You've looked at societal footprints of private equity ownership in like sensitive sectors like journalism and housing. I guess the question is, how can institutional limited partners or LPs better hold GPs accountable for what may be real world impact from aggressive cost restructuring? I mentioned journalism and housing, but let's shift it to something more more perhaps meaningful, like healthcare, hospitals, medical services. Thoughts on that?
Yeah, I think if I had a solution to this, I'd probably be in another career, but it is a very difficult problem. I think honestly, the solution, let's look at what's happened. The solution for your last examples, healthcare, even pet care, industries connected to government subsidies, so student loans, private education, and Medicare, Medicaid, healthcare. My understanding is the industry, PE in particular, has pulled back. I think they appreciate, on the one hand, bad headlines. Two, the model pushes them towards optimizing. You said cost cutting, but the other is just optimizing. Look, this is an insurance model. What are we going to do? We're going to figure out how to bill, not illegally. We're just going to be very efficient at billing insurance, right? Again, not illegally. This doesn't look good, and it's not the greatest way that LPs want to make money. So my sense of what the industry has realized is the toolkit and model works in healthcare if your job is to maximize value, but it doesn't work as a whole, as a product, and they've pulled back. Now, I'm not going to give them credit for that. It took some mistakes for that to work, but talk to practitioners and they'll just say, we stay away from these areas now, even though there's money to be made. And I honestly think that tells us it just can't be solved. And someone who's trying to solve it probably doesn't really appreciate the real problem.
Yeah, look, I think as I'm a proponent of capitalism, and I think of discussions I've been in with people like our fellow colleague Joe Stiglitz and others, and there may be a structural flaw where the less a medical provider pays out to physicians and patients, the more profit. And then, by the way, of course, they're incentivized by equity and options. What's like the concept behind regulated utilities for electricity, right? That might be that might need a different solution or a more nuanced solution, right?
Yeah, I very much agree. I don't regulated. I think infra is going into regulated industries, and less my area of expertise, but those PE firms are probably full of experts on regulatory and legal policy that hopefully solve these problems. But it is a very tough problem. I don't hear as much about ESG from investors as I did before. I think it's a political change, but many of them deep down do care about this. And I think on average, they appreciate the downside risk and the welfare consequences for the economy on average, but there are going to be some bad apples out there.
Yeah. Okay, let's move to the third segment, technology. And you've done some cutting edge work on let's start with the corporate hierarchy and the reshaping of it. Your recent working paper on corporate hierarchy uses network estimation across a significant number of online resumes to look at organizational structure. And you noted that highly hierarchical firms exhibit better operating performance, but face material administrative friction. So the question is, how should corporate leadership use tech to optimally balance between execution and agile innovation?
So the project is, one view of hierarchy from someone like me at a business school is it's just pure bureaucracy, right? Like, why can't I just go teach my class? Why do I need all these steps along the way, people to approve this or that? In the corporation, it's probably not the right view. So it's my own bias. What we explore is firms are making complex decisions about adding layers of management, adding layers of workers. And they, most of the time, are doing this using the trade-offs that they understand, right? There are costs of doing this, like the administrative overhead, but the benefits could be quite high. So what we find is evidence that these hierarchies are playing a real role for helping incentivize workers. So a classic story is it provides a really clear job ladder for people to invest their human capital in a firm. That benefits the firm, and that benefit accrues to shareholders. This comes at a cost. You pay workers more. There's a little less mobility of your workers. But to your question about tech, what we do in the paper at the end is we've got layers. So the average public firm has about 10 layers. That's our headline result. We can explore when firms move into AI, they start hiring AI experts, they hire machine learning experts, things like that. Now, the benefit of a layer is you basically get specialized workers who can solve very narrow problems, and the managers basically deal with exceptions. In a world of AI, you now have a sort of assistant who can help you learn quickly and presumably gives you more scope for what your knowledge can apply. And this would suggest that you would flatten firms. And this is what we find. We find that the introduction of these technological innovations flattens the firm in ways that you would expect given what AI is doing for all of us on a positive side. So this tells us that hierarchies are presumably solving the very things that AI is now solving for us, right? Information aggregation, specialization, and the like.
Interesting. Okay. Let's move to the next part of this technology segment, startup board evolution. You've got some unique data sets tracking board dynamics over startup life cycles. And this is kind of a coda to the beginning of the conversation about founders retaining more equity and board control during their first few funding rounds. I don't know. Is there anything to add on this? Because we did cover significantly in the beginning. Anything to add on that?
So yeah, indeed, it is connected to the broader phenomenon of founder bargaining power increasing over time. But what the paper asks starts with the following fact, which is that the private firm board is effectively the Wild West as compared to public firm boards. So if you're a publicly traded company, you've got listing standards from either NASDAQ, NYSE, or others, which are effectively inherited by the SEC. The headline result is you need to have a majority of independent shareholders in most situations. Private firms, there is effectively no rule except in Delaware, you have to have a board. But what ends up happening is once you start raising external finance, there are corporate governance reasons and corporate law reasons why you would start adding shareholders to make sure when you make big decisions about the firm, you don't fall into a trap of being sued by your shareholders. So what we found is that despite it being the Wild West, venture capitalists play an important role on the board. And there's this third party that many of us know, independent directors, that are surprisingly prevalent in startup boards. And what we document is that these startup independent directors are basically playing the role of mediators. So venture capitalists have strong objectives, financial objectives to exit the company and generate value through that. Startup founders, as we described, like staying private, they like running their company, and they often disagree. We'll bring in a third party called an independent director to help break ties and solve these problems when the board faces big decisions. So the paper is interestingly about this dynamic, but also just why are these boards structured this way? It's because professional capital and founders often are at very big disagreements and big decisions, and boards have to function to solve and move the firm forward.
Helpful. Okay. That makes sense. And then the last segment of technology, quantifying intangible capital, which is obviously in the world of information data, LLMs, more relevant than ever. And so in your paper, Measuring Intangible Capital with Market Prices, you tackle that incredibly challenging task of valuing intangible assets and IP. And obviously, as we do continue to become increasingly tech-driven and asset-light, barring the manufacturing renaissance in the U.S. But though even joking aside, even that will increasingly be technologically driven with robotics and automation and, to your point, flatter hierarchies, I think, less people, more robots, machines. How can investors better leverage quantitative measures to twofold? I guess one, to find maybe mispriced alpha, and two, to better value it, because obviously most accounting is from, and I will wrap the question up in a moment, most accounting is from some time ago that predates this intangible technological capital and IP. So I'll pause there.
So the question is, how can firms better account for their intangibles based on their research?
Sorry, it was a bit of a rambly. The question is, I think there are a couple of questions for you. One is, if you could give your thoughts on your conclusions on balance sheet, because that's controversial, right? That balance sheets don't really account for IP, right? Because accounting predated this stuff. And then the other question is for investors, how alpha opportunities in terms of mispriced alpha opportunities, do those make sense or not really?
Yeah, they do. Yeah. So the let's start with the first one. So yeah, the accounting rules, I used to teach a little accounting. It makes sense to me why you can't capitalize all R&D and capitalize all marketing, because the connection between that, which is currently an expense, but let's call it that capital investment, and the cash flows are not obvious. It could be a distance in time because it takes a long time to build a market, or it could be just huge uncertainty, right? You're doing an innovation. And the accounting system and disclosure just isn't suited for that. We have a trade-off. We want to report the assets and liabilities of this firm in a timely manner, in a regular manner. Adding this in the same vein as a plant, property, or equipment just kind of breaks the model. So I understand that. But what we do is we use realized purchases of intangible assets to back out what intangible assets are on balance sheets of firms. So simple example, Google buys a startup, a big one, and it brings it onto the balance sheet. And that startup has patents. Normally, Google cannot invest in a patent and put it on their balance sheet, but they do put it on their balance sheet if they buy it. It's an acquired intangible. And what we do is we basically say, here's now a price of intangible that comes on the balance sheet. We can see that startups, hypothetically, all the R&D they spent for the 10, 20 years before. So we can ask ourselves a question, what kind of model of capitalization would that startup have used to get that price that Google just gave us? And what we find is it's meaningful. Basically, the depreciation rate is much higher than CapEx, but it's not 100%. And then what we do is we calculate intangible assets on balance sheets are a big deal. So market to book type things, if you adjust book for intangibles from an alpha perspective, that book is a lot bigger if you use our intangible stock. So from your question about alpha, I don't know if our model is the right way to do it. There are multiple ways to do it, but this is a relatively straightforward method to do an adjustment to balance sheets to understand high intangible asset firms' assets and in turn risk, what their return on invested capital is, things like that. So it is, I don't know if we have a direct result about what's the better firm to buy versus other, but it's a toolbox to improve your understanding of balance sheets.
Oh, okay. Great job answering my poorly phrased questions. Okay, and then moving to the sort of tail end of the discussion, do you have a favorite book or one you've read recently that you think highly of, or anything you recommend reading? It could be related to our discussion, or it could be entirely orthogonal.
It's not completely orthogonal, but the book I recommend people these days is a book called A Brief History of Intelligence. I believe it's by Max Bennett. It's a story about neuroscience, and you can understand why I might have read it. It's about the science of the brain and what we know and don't know, and how the AI revolution has learned from neuroscience and vice versa. And my takeaway, I tell people, so I've probably said this before, but the biggest takeaway is the gaps that neuroscientists have in their understanding of our brains is so large that I felt much less comfortable in a world that we live in where everyone says AI and the Terminator's coming. I just don't believe it, because how little we know about how our brains and neurons work suggests that, no offense to computer scientists, but they're going to have to solve the same problems. And we have a long way to go. So it's both good and bad. We don't know as much about ourselves as we think we do, but also means probably Terminator is not here yet, and we're safe for a little while.
Interesting. Okay, that's comforting. And what's the single best piece of advice for allocators and or investors navigating today's private markets?
Ooh, best advice.
Or I can broaden it to something that you think they're perhaps not thinking about and should be, or maybe something that you are starting to think about that you are going to research or would think that should be more topical.
Sure. Okay, so on that one, so big allocators, the ones that are already playing in alternatives, the ILPA came out with a great white paper on this that I've been exploring myself, which is the question allocators need to ask with this retail push is, what is this going to do to the decision-making, structuring, and investment strategies of GPs? I think the lower middle market firm is not going to raise from retail. They're not going to be impacted. But the big players who are raising the bulk of money these days drive a lot of the market. And if they're raising capital from less sophisticated, higher liquidity need investors who are going through multiple channels to get to them, adding all these complicated requirements, it could change, and my research suggests it does, change the way GPs run themselves. And I think this has big implications on the alternative space overall. And I think it's the biggest downside risk. Yes, individuals could lose money in privates. I think it's going to be such a small slice of their portfolios. I'm not super worried about that. I'm actually worried about the industry itself. The industry works because it's long-term, buy and hold, active. If that breaks, which it could, then the whole model, I think, is broken. And I think as I'm an allocator, I'm asking very tough questions of my GPs about their growth in this space and what they're going to do to protect their models.
Wait, just at the risk of being, oh, how shall I say, thick. Well, like, you just give a few examples, like specific examples of what these GPs could be doing that would be so destructive.
Thank you. I should have given an example. That's great. It's not being thick. The best example is from my research is the interval. There's this big push for interval funds and tender offer funds that are wrapping private assets and alternative assets for accredited, non-accredited, and high net worth. Those funds, those vehicles, when they make investments in funds, so I invest in you, you go invest in private equity and venture capital funds. What those managers are doing is they are investing in funds that are a little bit more cash flow friendly. They're investing in funds that generate DPI at a faster rate. The question is why they're doing that. They're doing it because they have liquidity needs. Their investors, you and I, accredited investors, high net worth, demand quarterly redemption rights. If I'm a rational manager of that fund, I'm going to invest in both cash, but also I'm going to make sure that my illiquid assets have a little bit more liquidity than otherwise happens. Now, imagine taking that phenomenon to the entire asset class. We're now going to have managers being like, you know what? I probably should invest in this young widgets company. I'm going to invest in a little bit older one that's closer to exit because my investors might demand capital sooner. That's the worry.
Got it. But is it not possible, though, that it bifurcates, that you have two distinct pools of capital and they're not pari passu? So you have one for the interval funds, et cetera, where they need this greater liquidity, and one for the institutions who maybe don't need the liquidity to the same extent?
It's a great point. And yes, that is possible. But this comes to another point, which I think allocators need to consider, which is much like institutional blockholders in public markets and activists in public markets. The reason the average CEO of a public firm doesn't shirk, steal, and fraud, I think, is they have large shareholders that keep an eye on them, right? They discipline them. This is the same, in my view, for private markets. Managers need large institutions to be large shareholders to sit on LPACs, right? So if we have bifurcation, we lose that, right? We lose the disciplining of having sophisticated, large investors in funds. So I agree that could happen, but I think then it falls apart in a different way.
Yeah, no, I think that's right. Yeah, there's no comparison in the sophistication of large allocators and asset owners versus retail. And then, of course, you do also have the concentration, the ability of a few larger, more powerful investors versus a fractionated or fractionized retail group of investors. And it's a bit like retail not really voting, whereas theoretically better, larger investors do.
Exactly. And so long as we need LPACs and we have continuation vehicle decisions, we've got complex GP turnover, we have changes in carry, we name the things that LPs have to sometimes chime in on, we're going to need these players. And I think private markets are defined by not making decisions about assets as an investor, but making decisions about managers. So the delegated part is never going to go away. I'm happy to put that prediction down in this. We're never going to have direct investing. The LPs that are doing direct investing, the sovereigns, have teams. They literally have just created GPs in their fund, in their vehicles. So retail's never going to do that. We need managers to find assets and manage them for us. So we need those managers to be managed too.
Yeah, we just had Josh Lerner on, it hasn't aired yet, but who I know you know well as well from Harvard. And one of his studies, which I'm sure you're familiar with, is that co-investments, despite having low or no fees, end up with the same net return as fund investments, which indicates there's an adverse selection bias. So to your point, yeah, if that's historically, obviously, with institutions, then it's pretty clear if institutions can't outperform or aren't outperforming on co-investments, certainly retail's not.
Indeed. That's well put. And Josh, whatever Josh says, if he disagrees with what I said, he's right, I'm wrong.
No, I don't think anything you said disagreed. But anyway, all right, cool. Okay, look, Mike, thanks so much for the fascinating discussion and for sharing your most valuable asset with us, your time. We hope listeners have a better and deeper appreciation for your perspective and how we can apply these insights into particularly private markets and the democratization of alts as investors and allocators. This is your host, Michael Oliver Weinberg, inviting you to join us next time when we speak with another thought leader on improving alpha through innovation. Thanks for the time, Michael.
Thanks for having me. It was fun.
Thank you for joining us on the Improving Alpha, Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.